Hello. Hi. Hello. Quite a few of you signing in. I was a bit late. Um, I apologize for being late. I'm very sorry about that. So I have quite a lot of things to talk about today. Can someone just tell me if they can hear me, please? Can anyone, someone just tell me if they can hear me? Yeah, cool. Somebody can hear me. Okay, right. So I have quite a lot to go through today. Um, that's my excuse for being a bit late today. So when I do these on the first of each month, I kind of try and do my kind of top 3 picks just to kind of contextualize the thread of the conversation. But this month, I'm kind of doing, I'm kind of adding one on top. So we're going to talk about PDD for a couple of minutes. And then I'm going to talk about just 5 minutes about 3 things that I believe can really help people to deliver 15% over time. And these are some guardrails that I feel that, everyone can do this type of investing. Anyone can do it. There's just some practical suggestions that I'm going to put forward to stop you from doing harm to yourself when investing. And then I'm going to talk about top 3 picks. So I'm going to just jump right in. So I recommended PDD, it's a Chinese company, and I said straight away that, you know, Chinese companies are really volatile, and if you don't want to get involved, absolutely understandable. Um, and I did that about 2 weeks ago now, I think. Maybe, yes, I think it was about 2 weeks ago. And I've got quite a lot of emails about it. So since quite a few people have written to me about it, I felt that it's probably useful to speak about it. And, for people that want to, will kind of deliberating in the back of their minds, or this, that, and the other, they will be able um, to see where I'm coming from. Okay. So I've known PDD for a little while. I have invested in it in the past, and it is a Chinese company, but that's not the main issue here. The main issue is that it's a very secretive company. It came out of nowhere and it just overtook Alibaba on the stage as a multinational company. And, you know, in business, there are always exceptions, right? So for a long time, for example, Amazon was the exception that they were continuously investing for growth. And until investors got aligned with that, a lot of businesses didn't follow that way of growing. And it was until like 7-8 years on that Wall Street came around to it, and then it got a massive re-rating that we now know about Amazon. And that was for a long time an exception. And businesses are full of exceptions that people were not accustomed to how things develop. And until they kind of get proven right, people understandably quite skeptical. So PDD is a very secretive company. They give you very little disclosure. And it's not that they give you little disclosure because it's a US company trying to invade or whatever. This is nonsense. And I read so much nonsense about it. And just, like, they were secretive when they were a pure play Chinese company. And this takes me back to the way that they became massive in China was for being extremely over promotional with their products, not their management team, but their products. So for a long time, they were running at break even, and investors didn't want much to do with them. And then there was like, I can't remember now if it was about 2 years ago or something. Might have been 2.5 years ago now, that they kind of went and that they kind of went and became slightly profitable, and people were like, whoa. So they actually are a profitable enterprise. So what they try and do is they try and get you accustomed to their services. And this works on the two sides of the business. So for merchants, they want to see that there's a lot of active buyers, and active buyers want to see that they're getting value. So it's a two-sided model. And when PDD reported their results 2 weeks ago, and you can see that the majority of their growth has come from them doing transactions, from them charging for transactions. And you can think of it in a way of like how PayPal used to belong to eBay, and that was kind of like a separate business. Sorry, that was a combined business, and people didn't see the value of PayPal, so PayPal got spun out and from eBay. So in the same here, when the gross margins of PDD have come down, even though the overall business has increased their free cash flow quite significantly, investors are like, oh, I don't know, maybe they kind of Timu's selling stuff at a loss, and it's going to cause some problems because the US, and when the share price comes down a little bit, people get all kind of anxiety and indigestion. But rest assured that provided that the free cash flow is increasing over time, things are going to be okay. So that's just specifically on PDD. If anyone wants to raise any questions specifically about PDD, this is a good time. Otherwise, I'll kind of press forward. Okay. Nobody wants to ask questions about that. That's fine. If you do, let me know. The next topic. So, as I said in the introduction, there are three things that I. Yeah, I should have said this.
Can I do? I'm looking at PDD on CNBC, and their address shows up as Dublin, Ireland.
Yeah, a lot of companies have this kind of. Amazon has it. Apple has it. So,
okay.
In Ireland, I think they pay 10% capital gains tax. So a lot of companies use this as a shelter, either Ireland or Luxembourg, because the tax rates are really, really low. It's part of a government scheme to stimulate the economy. There's not much more to say about that. I could go on, but I'm quite time pressed. But that's not a problem.
There's a tax.
The problem is whether they are growing by being over promotional, but whether domiciled is not a massive concern. Many multinationals are domiciled in Ireland.
Okay.
Thank you. Okay. Is there any other questions that anyone wants to ask about PDD? No. Okay. So we just finished Q1. Actually finished. I think it was. I don't know if it landed. I've been away, so I don't even know if the US bank holiday. If I think the bank holiday Friday was closed. But so I kind of took Q1 as kind of finishing on Monday, just for my simplicity. And deep value returns was up 27%. The S&P was 10, and the Nasdaq was just a nudge below 10. So we're doing okay. I wanted to mention 3 things that will make sure you are able to invest in a way that you can drive 15% per year. Okay, so one thing, do not invest in businesses with weak balance sheets. I talk about them every single Tuesday, I think. It takes 3 to 5 minutes, depending how proficient you are, to check the company's balance sheet. Those are the best 3 to 5 minutes you'll do in your business career. It's like a snapshot. Just look at how much cash. Just look at the side of the liabilities. You don't need to be an accountant. I'm not an accountant. You don't need to be an accountant. You just look at the current liabilities and the total liabilities. just look at how bulging those numbers are, really, to make it quite simple. If the current liabilities are large, you may have a problem. Just look, maybe what they're doing is kind of like Walmart, or where they the liabilities are large because they're taking quite a lot of inventory and they have to pay back that inventory. So that is working capital that is being supplied by your partners or your merchants. That's good. That's a positive. But if it says notes or debt, that's bad. Okay, don't need to make it too complicated. Just make sure that the balance sheet that you're investing in, and in fact, one of the businesses that I'm going to highlight as my top 3 picks doesn't have as strong as balance sheet as I would like. So I will highlight this as well when we go through it. But essentially, think about the balance sheet. 3 minutes, it's going to really make a lot of difference to yourself. When you're investing, you need to think about whether this is about your ego or your money. And the way I think about it is, are you trying to feel smart when investing, or are you really just trying to make money? And I say it quite crudely, but when the year end comes, you need to know whether the game that you're playing at is actually the game that you're working towards, because these days turn into weeks and they turn into months, and it really makes a difference that you know the game you're playing at, because you can optimize to the game you're playing at if you know the game that you're playing at. I'm consistently focused on driving that equally weighted portfolio because I'm thinking, okay, is this business that I'm investing in going to be more free cash flow positive next year and subsequently the year after? So I'm constantly thinking, not what the management team is telling me. I've done that mistake in the past, and I don't feel that I've ever been successful when I've taken management's narrative at face value. I'm repeating myself here, but it's a quote from Charlie Munger that I always think about, that when they're talking, they're lying, and when they're quiet, they're stealing. Management team has one job, and that is to be a leader, that is to persuade the stakeholders and the stockholders to follow their vision. Now, the management team has that responsibility to lead. So they lead by telling you a story. Now, the story, if it's backed up by the financials, great, happy dory. If it's not, then it's a drama. So you need to be very, very focused on increasing free cash flow over time. Okay. And the final one that I want to talk about is, don't fight yourself. And by that, I mean, when you invest, my holding period is 12 months to 18 months. So when I invest in a company, I know that I'm tied up to that business for about a year. So there's no exit. I need to know that what I'm doing makes sense, and that business is going to have more free cash flow, and that it has enough cash on its balance sheet to get to where it wants to go. So as a corollary to that, do not put more than 10% into any business, no matter like how well you know the management, no matter how well the story, like the time, the whatever, just 10%, because we are investors and our duty is to invest capital in a diversified way that you are not going to get blown apart, because there's always something you don't know about these businesses. Always something. You're never going to know everything. Okay. And I'll give you an example that I was thinking about as I was writing this down. So Berkshire Hathaway is one of the most followed businesses in the world. And Warren has spoken at length for more than 50 years about Berkshire Hathaway. And even the closest analyst following his company hasn't got a clue what's under the bonnet, okay? So you can think you know something and you don't know something, okay? But provided that the free cash flow increases over time, you will figure out over time whether the business is worth more or less. So Berkshire sometimes gets a large premium, sometimes the multiple compresses. But by for all intents and purposes, Berkshire doesn't really get a multiple that is commensurate with, let's say, the Magnificent Seven. It always trades a compressed multiple because people kind of don't really know. The market doesn't really know. You kind of trust Warren, blah, blah, but you kind of like, you don't really know what's under there. But as long as the free cash flow is increasing over time, the market rewards that. As a different example, Constellation Software. People don't really know exactly what's on Constellation Software, but you kind of have a vague idea that the free cash flow is increasing. So the market rewards that. So you don't need to know everything like Palantir, where the CEO is like constantly on his diatribes. You don't need that. And I gave you the example of PDD being quite secretive. So there are businesses that you kind of don't really know much about, but provided the free cash flow continues to increase over time, everything's going to be okay. Now, as a concluding point that I wanted to make is that anyone can make money here in the market, right? Like anyone can do it, but it's not that you need to be the smartest, the brainiest, the highest IQ. You need to have the stomach to do it. And by that, I don't mean to be a bravado, but you put some rules in place that align with your personality to stop you from doing things that kill your performance. So don't blow up. Don't invest in businesses that are over leveraged. Don't just follow a story. Focus on the increasing free cash flow. Okay. Does anyone want to stop here and talk about what we just discussed? This is like a two-way street. Like I'm doing this for you, but you know, if you ask questions, it's going to be more. You'll get more out of it. If anyone wants to ask questions, just interrupt now.
Yeah, I find that investing in China makes me nervous because, like, for the same reason you said, they're secretive, and I think they're following what are the GAAP standards. But there was that coffee company that went bust, and I was in it. I sort of sold, bought, I sort of broke even on it, luckily. But you know, things like that. So I actually personally try to avoid China as much as I can.
And I always say, do what aligns with you, because what you buy, you're responsible for, and you need to buy when you have full conviction that you are willing to be accountable for your actions. So I'm always talking about full accountability all the time. All my conversation is be accountable to somebody else. For me, it's helpful to be accountable to my wife and my daughter. I think, okay, I'm doing that for them. So when I work, I'm working for them. I'm accountable to them. Maybe, I don't know, you want to be accountable to your grandchildren or your son or your daughter, whatever, dog. But be accountable to somebody. That's your why. Why are you doing that? And if you cannot be willing to underwrite something, that's okay. Next week or next month, there's a new stock that shows up, and that's fine. Go with something that you're willing with conviction to feel, okay, I think that this stock has all the criteria that Michael talks about. For example, a clean balance sheet, increasing free cash flows. And I'm not going to get too anxious, because the problem is a lot of people kind of get invested in a stock. For example, let's just be honest here. I do a service, right? And I'm very passionate about my investing. And I can easily convince somebody to do something, but I feel that it's counterproductive to do that. I feel like you invest in things that you're willing to hold responsible for yourself. I do all the work, but I'm wrong 50% of the time. So I feel about that. I think, okay, I'm doing the legwork. I feel, quote unquote, that I know this business because I have been invested in PDD in the past. So I kind of feel I know this business, but I also know that I make mistakes. So those are my cards. I'm very open. I'm very transparent about that. And I let everybody make this decision for themselves. If it doesn't sit right in your stomach now, don't buy, let it fall 50% and then feel unwell in the stomach. You know what I mean?
Mm-hmm. Okay. Yeah.
Does anyone else want to ask any questions?
Yeah, well, I find that I make my investing mistakes when I get emotional.
Mhm.
And, for instance, Money Lion, if I had a bought when you recommended with the stake I have, I wouldn't need to be on this call. But I bought it 575 in the old price and cost benefited down, so I'm whole again, but I'm still making silly mistakes. Like I sold at 66 and it went to 79. Then I bought, I forget how many shares, 10,000, I think, and then sold it at 76, or 77, getting out, and it's just like that was so unnecessary. I've been holding it for so long. Why did I do that?
May I just ask two questions first? So again, what I said at the start, kind of be true to who you are. So I'm always saying, this is my holding period. And, I'm very clear about that. And I said at the start here, like, don't fight yourself in that, don't do things that are you're gonna doubt, you know what I mean? The first thing. Second thing, very, very important. This is really, really important. Nobody cares the price that Peter paid for his stock. Nobody cares. So whether you bought low, bought high, bought sideways, nobody cares. You need to have a view of where it's going, not where it's been. I feel as well, and I could be wrong, I don't know you personally, but your time horizon is quite constrained. That doesn't necessarily overlap with my time. Like I've only been in a stock for about 4 or 5 months, maybe more now. Sorry, November.
Yeah, no, but it's been when it really took off.
Sorry,
and
yeah,
that's the thing. I got in too early because I got emotionally invested in. This is a great management team. It's a great idea. They've got a solid market niche and good cash flow. And it was like, well, yeah, it wasn't free cash flow, but it was, enough that they were going to survive. But nobody else seemed to see it. And it's just, I kind of logically worked my way into part emotional, part logic into a trap on that one. A value trap.
The first thing is, it's extremely important to do what you're doing, which is to reflect, first of all, okay? To recognize. That's how you grow. Investing, I say this every time, investing is about aligning your personality with your portfolio. You need to align that. You need to grow. Next, whatever trials and tribulations you've been through with Money Lion and it's caused you that pain, that is the pain that you need to embrace so that next time you don't do the same mistake. Because we're all going to make mistakes. This is a business that people make mistakes all the time. But you need to be humble enough to admit with your stomach and your head that, okay, you know what? I failed here. And it's okay to fail. But what I will say as well is that having this guard for me, it works because my personality of 12 months kind of says to me, hey, I'm going to buy, and what in the case of Money Lion, but this is going to be applicable to other businesses, I am looking at the free cash flow per user or per customer. So provided that the customer adoption curve is looking like it's going up, I can forgive a lot of things, but you need to see, the example that I like to highlight is Spotify. I don't own Spotify, but it's just an example I like to highlight because the number of user growth is increasing over time, but the revenue is really choppy, okay? And I know now looking back, Spotify is just like a rocket going into outer space. But I follow Spotify quite closely, and the share price was not a rocket going into outer space. There was a lot of quarters there where a person was down 40%. So, but if you follow this strategy, which I like to use, which is following the user growth and the 12-month holding period, a person would have been reasonably okay. Even if you had a crap price when you bought, you would have been reasonably okay. So that's why I say, if you make a mistake, that's okay, but that's the cost of the tuition to make sure you don't repeat again. You need to graduate, and that's the cost. So, I've done all kinds of crap, and I've made a lot of mistakes, and that's okay. But you need to take a step back and reflect and try to improve. Try to reflect, okay, what did I make a mistake with? Now, in the case of Moneyline, you know, it had all the reasons to be a Wall Street favorite. And in investing, it's much better to be lucky than smart. You may have been smart in figuring out that this is going to be a great business. I was lucky with my timing. So, you know, but luck will only take you so far. You need to have a bit of passion and put in a bit of, you know, willpower to align that. And it's spend a lot of time kind of thinking about really what is it I'm trying to do. Again, go back to the basics. I'm trying to see the free cash flow increasing over time, the 12-month holding period, so that I'm not, you know, sometimes certain stocks, look at Giga Cloud Technology. This stock goes up, down, up, down, up, down. Like it's absolutely mental. I haven't got a clue. But and if I had a stop loss every time that it went down, man, I would have been out like donkeys ago. But I said to myself, okay, I did buy one more time at $21. I bought it at I think it was 15 or 16. Let's say 16, doesn't matter. I bought it 16 and I bought the time at 121. And then on the day that I bought 21, I was like, oh, that's a great price. About 2-3 days later, it went up in the one day 20%, down 40%. I was like, oh my God. But I have this, I know from experience that having this time horizon, this guard, it's okay to make a mistake. After 12 months, you can exit. You know, that's fine. Didn't work out. But now things are kind of stabilized and I've seen the results continue to improve. I'm like, okay, if I want to add more money, I can add more money. That's fine. But I put this guard to protect myself. Does that make sense?
Yeah. Oh, yeah. I mean, when Moneyline got down to 750, I'm like, should I buy a lot more? And I was like, no, I'm so disgusted with this stock because of the up and down 20%. I mean, it's wrenching. I mean, if you were swing trading it, you could make a huge amount of money if you could call it properly.
So, yeah, in hindsight, everyone can do everything. And in hindsight, it looks so easy. And there are people that are good swing traders, and you know that's good for them. But though it's a difficult game, and the odds of success in that game are extremely limited.
Yeah.
The odds of success in my game are pretty easy. It's really, really easy, provided that you reflect, you put rules for yourself, and you're systematic about it, and importantly, you remove the emotions of yourself in your portfolio. So that's why I kind of try and say, look at this, look at that, look at that. I make it quite quantitative so that there's no ambiguity. Oh, the management said this, or blah, blah, you know, like people say all kinds of things. So focus on two key variables. I like to look at user adoption and I like to look at free cash flow. Whatever it is for you, follow one or two key variables and just nail it and just be accountable and say, okay, this is the thing. And for me, I personally find, hi George, I saw you just logged in. I personally find that writing this down is really helpful. And I've spoken about this before. You know, you don't need to kind of write, you know, you don't need to be the next Tolstoy. Just write 3 bullet points. And the valuation should not come into it. Do not say, oh, because it's cheap. Like say, like for me, user growth, I like the balance sheet, I like the free cash flow. Those 3 bullet points, and that's it. Game over. 12-month holding period. And you will learn so much about the business. I always give the example to everyone about Apple. So or, you know, if you like in America, a lot of people like Apple phones, you may be the biggest Apple fan, but until you bought a share of Apple, like you haven't got a clue about that business. You're not a shareholder. You don't know anything. Once you're in the business, then you learn more about the business. But of course, that there's a better way to learn about business, and that's by studying the business. If you follow a lot of businesses, you can study those businesses and you can see what overlaps with other businesses and you build a database. Maybe at some point, I will buy Apple, maybe, you know, but you kind of build a database and a backlog so that your information grows over time, and you position yourself to be humble enough to say, okay, I'm going to make mistakes, and how can I improve? Yeah. Would anyone else want to ask any more questions about anything we talked about right now? Okay, so these are my top 3 picks that I wanted to highlight. So this was what the call was supposed to be about, and I kind of just waffled on for too long. So I really like Robinhood, and it's one that I've been kind of mentioning profusely for a while. And the reason why I highlight it yet again is because I really like, I just think that this business can do quite well. Number one thing that I like, it's got about 35% of just cash on the balance sheet. So it's like 6 billion in cash, no debt. There is some more cash, but that's restricted cash, but it's 6 billion clean. I like that. Nothing's going to happen to this business. Number 2, again, go back to what I said, user growth or customer growth. In this case, I'm looking at net deposits. So the amount of money that people are depositing in Robinhood is increasing at a rapid rate. I estimate it's going to be close to 11 billion for Q1. That means it will be up about 35%, more or less, maybe 40%, maybe, I don't know, we'll see. Let's say 35% compared to a year ago. So if you have more deposits and people are using your brokerage service more, hey, things are going to happen. Positive things can happen. Last time for the year 2023, they made $1 billion in free cash flow. So I'm just thinking, okay, if they made $1 billion then, and it's about 16 billion market cap, and they have a huge net cash position, positive things may happen. Number 2, LifeMD is another one that I've been talking about a lot. I like this one because they are openly discussing since last year, hasn't happened yet, but they're looking towards spinning off this kind of like mini DocuSign this side of the business. And they say that that's probably worth around 70 million. Just for round numbers, I have pretended that this is worth for them 100 million, just make it round numbers. So like a quarter of the business is going to be spun off. So that's going to be cash onto the balance sheet. And it does have a tiny bit of debt, but it's not a problem, particularly once they get the cash from spinning off the business. And I estimate that their telehealth business is going to make about 30 million of EBITDA this year. So it's about a 13 times multiple to EBITDA. So I feel that like a business, and the telehealth business, I feel is growing at about 60%. So it's just tremendous growth, and GLP-1 has just really just started. So I know that there's competitors and there's no differentiation, but for now it's like the it's just massive amounts of growth. So you have a strong balance sheet, you have strong growth and strong cash flows, and the valuation is not excessive. Something positive may happen. And finally, the one I want to talk about is AppLovin. So I like AppLovin because—
Could I interrupt for just a second? I missed the name of the second one.
LifeMD. Life.
Oh, LifeMD.
Yeah. And the last one that I like is AppLovin. I like this business because 60% of the business is what they call their software business. This is like giving, I know now AI has become like a massive buzzword, but basically it allows advertisers to track how successful their ads are through the AppLovin ecosystem. Then they have the 40% of the business, which is quite crappy, called the apps, which is basically on the mobile apps on the phone. You are able to, have free games, and when people pay free games, they collect a lot of data from you. But because this whole GDPR and anti-cookie and blah blah blah, it's quite a crappy business, but it makes quite a lot of cash flow. So I like it because it makes a lot of cash flow. It's obviously not growing much, but the 60% of the business, that's growing at a really fast rate. So it was a very strong quarter just now, and they had the rule of 40 of about 135. So it's just like, poof, it's like they're making like printing. Now, here's the trick. the way that they do their accounting is a bit like Meta does the accounting, whereas other advertising businesses have different ways of doing accounting. So the accounting that they report is already kind of as if, quote unquote, a gross profit. I'm overcomplicating things. Just focus on the fact that they make a strong amount of free cash flow, really strong. I believe they're going to make about 1.5 billion of free cash flow. I estimate that is priced at about 15 times free cash flow. And lastly, the share count has actually been coming down since 2021. So share count coming down, free cash flow going up, growth is just very, very strong. And now also, just as a little finale, the management team as a whole owns about 7 to 8% of this 30 billion company. So strong insider ownership, not that it's a massive thing, but it's nice to have. Yeah, and that is the end of me. Would anyone like to ask any questions?
Did I get the name correct? It's App Loving?
Yeah, one word.
Okay.
I got something to ask you about. I don't know if it's so much a question, but there's a guy I'd like you to look at on YouTube, a guy named Tom Nash. And I mentioned that because he thinks that Planetar is going to the hundreds of dollars. And he talks about it and he has an opinion. It seems like he has a good track record. So I was just wondered if you have some spare time, maybe look at that on YouTube. His name's Tom Nash.
Just send me the ticker just send me the ticker on the chat. I like to do my own thinking. Just send me the ticker
Okay.
on the chat. Thank you,
Okay.
George. Thank you so much. Well, okay. Thank you very much, everybody. Really kind. Thank you so much. And hope to see you next Tuesday, same time. Thank you very much, everyone. Thank you.
Thank you.
Thank you.
Thanks, Michael.
Bye.